Welcome back to the Florida Veterans Real Estate Podcast, where we turn military benefit into civilian financial firepower. I'm Darian's avatar, and this is episode 10. We've mastered the COE, and now it's time to transition from pure home buyer to tactical real estate investor. Our mission today is simple: how to use your zero-down VA loan to acquire your first property, live in it for 1 year, and then turn it into your first income-generating asset. This is the stepping stone strategy. The conventional wisdom is that a VA loan is for your forever home. That's a passive, defensive mindset. Our approach is action-oriented. We view the VA loan as the most powerful, zero-cost launch platform in existence for building an asset portfolio. The VA loan is not intended for investment properties. That's a critical regulatory truth. But the VA's rule set, specifically the owner occupancy requirement, contains a legal and ethical loophole that, when executed precisely, allows you to convert your primary residence into a rental property with unprecedented financial advantages. The stepping stone strategy allows you to do the following. 1. Acquire a property for 0% down. This is your non-negotiable starting point. 2. Build tax-free equity during your occupancy year. 3. Rent it out after satisfying the occupancy rule. 4. Buy your second home, your true forever home, using the remaining portion of your VA entitlement or the full benefit if you utilize the one-time restoration rule. This strategy immediately establishes you as a landlord and portfolio builder, not just a homeowner. It separates the veteran who merely uses the benefit from the one who maximizes the benefit. This mission brief will break down into 4 critical phases. Phase 1. The regulatory roadmap, the precise VA rules on occupancy and intent that make this maneuver legal. Phase 2. The 2-unit force multiplier, how to maximize the stepping stone strategy by buying a duplex, triplex, or fourplex for 0 down. Phase 3. The financial transition maneuver, when to move out, how to qualify for your second loan, and the power of the one-time entitlement restoration. Phase 4. Force protection and the tax advantage, protecting yourself from audit and utilizing the massive tax benefits of being a landlord. This is your blueprint for achieving financial leverage. Let's engage Phase 1. To execute the stepping stone strategy, we must have a flawless understanding of the VA's occupancy rules. You must demonstrate good faith intent to occupy the home as your primary residence. Any suggestion that you are buying the property solely as a rental or investment property is a violation and grounds for the loan to be rejected or audited. The core VA occupancy rule. The regulation is simple. You must certify at closing that you intend to occupy the property as your primary residence move-in timeline. You are generally required to move into the home within 60 days of closing. The intent requirement, the 1-year standard. While the VA does not have a hard and fast lock-in period, the practical standard used by nearly all VA lenders is 12 months. By living in the home for approximately 1 year, you clearly demonstrate that your initial intent to occupy was genuine, satisfying the regulatory requirement. Proof of occupancy. How do you prove this intent? The lender will not physically check on you, but documentation must exist. This includes updating your driver's license address, filing for homestead exemption with the county, a massive financial benefit in Florida, changing the billing address for your utilities, receiving mail and tax documentation at that address. The tactical advantage of the 12-month rule. Once you have satisfied that year of occupancy, you are tactically cleared to move out and convert the property to a rental. The crucial advantage is that you do not have to refinance the VA loan into a conventional loan. The zero-cost conversion. Conventional loans for rental properties, investment properties, require a minimum 20% to 25% down payment and carry higher interest rates. By legally converting your VA primary residence to a rental, you avoid the massive capital expenditure of a down payment, keep your lower VA interest rate, and avoid all the closing costs associated with refinancing. This is the ultimate financial lever. The debt elimination focus. A core principle of maximizing business revenue is minimizing unnecessary costs. The ability to avoid a refinance and its associated costs and higher rates is a direct execution of this principle. You are maximizing cash flow right out of the gate. Exceptions to the one-year rule, the PCS override. While the 12-month period is the standard, the VA recognizes that the military lifestyle is anything but standard. Permanent change of station PCS orders. If you are active duty and receive official PCS orders requiring you to move to a new duty station, the 12-month clock is immediately superseded. You can move out, secure a tenant, and rent the property before the year is up, provided you have the official orders. Other documented changes. Changes in employment, health crises, or mandatory job transfers can also serve as a basis for an early move-out, but these require specific documentation and lender approval. Force protection, IRRRL maneuver. If you are renting the property out because of a PCS or other early move-out, you can immediately utilize a VA interest rate reduction refinance loan, IRRRL, often called the Streamline Refi. The benefit: the IRRRL is a low-cost, minimal paperwork refinance that allows you to lock in a lower rate or convert from an adjustable to a fixed rate. The occupancy clause. Crucially, the VA does not require you to recertify your occupancy when executing an IRRRL. This locks in your low rate permanently on your new rental property, a key component of the stepping stone strategy. By understanding the rules of occupancy and the power of the IRRRL, you turn a single loan benefit into a powerful, long-term real estate asset, all while adhering to the core regulation of primary residence intent. If the single-family home stepping stone strategy is a rifle, then the multi-unit stepping stone strategy is a heavy machine gun. It uses the exact same zero-down benefit, but delivers immediate positive cash flow. The duplex/triplex/quadplex advantage. The VA loan allows you to purchase a property with up to 4 units, a fourplex, provided you meet 2 mandatory requirements. 1. You must occupy 1 unit. 1 unit must be your certified primary residence. 2. All units must meet minimum property requirements, MPRs. The property must be safe, structurally sound, and sanitary, which can be a higher hurdle for older multi-unit properties in Florida. The immediate cash flow benefit. When you buy a multi-unit property with a VA loan, you satisfy the occupancy requirement by living in your 1 unit. You are then legally cleared to rent out the remaining 1, 2, or 3 units immediately. You do not have to wait the 12-month period for the vacant units. The ultimate house hack. This is the most powerful financial maneuver in the VA playbook, often called house hacking. Your tenant's rent payments cover all or most of your entire mortgage payment. Qualifying with rental income. A specialist VA lender will allow you to use a portion of the projected rental income from the vacant units to help you qualify for the loan. The 75% rule. The lender will typically take 75% of the appraiser's estimate of fair market rent or 75% of a signed lease agreement for the vacant units and add that to your qualifying income. The remaining 25% accounts for vacancy, maintenance, and operating expenses. The financial example: total mortgage payment, PITI, $3,000 a month, duplex, 2 units. You live in Unit A. Unit B rents for $1,800 a month. Qualifying income, $1,800 times 75% equals $1,350 a month. Net debt, offset. This $1,350 significantly offsets the mortgage payment, making your DTI ratio much more favorable and potentially allowing you to qualify for a more expensive property than you could on your income alone. The strategic play, financial leverage. Financial veterans who built their wealth understand that the fastest way to wealth is to leverage OPM, other people's money. When you buy a fourplex with a $0 down VA loan, your tenants are paying down your principal and covering your interest. Accelerated equity. In 1 year, you have created 4 streams of value. 1. Principal pay down, your tenants pay it. 2. Appreciation, market-driven equity, especially in Florida's hot market. 3. Tax write-offs, depreciation and expenses covered in Phase 4. 4. Full entitlement restoration path. You set up the perfect exit strategy for the future. This multi-unit strategy is the single best way for a veteran to turn their first VA loan into a long-term, wealth-generating asset foundation. After the 12-month occupancy is satisfied, you are ready for the transition maneuver, moving out, securing your new home, and deciding how to handle your entitlement. The second VA loan decision, entitlement strategy. When you move out of your stepping stone property, you have two primary options for financing your new primary residence, your second home. Option A, using remaining, bonus, entitlement. The mechanism, you keep the first VA loan and simply use your remaining entitlement for the second property. How it works. Period. The VA's entitlement is nearly unlimited, but you must cover 25% of the loan amount above the county limit. Since you used a portion of your entitlement on the first home, you only have the remaining amount available for the second. The cost. If the remaining entitlement is insufficient to cover 25% of your desired new home's price, you will be required to make a down payment. The downside of this is that the entire reason you are doing this is to avoid the down payment. Option B, the one-time entitlement restoration, the zero down second home. The mechanism. This is the strategic maneuver. You apply for a one-time restoration of entitlement. The condition, You can only do this once in your lifetime while you still own the first property. It requires you to fully pay off the original VA loan, usually by refinancing it into a conventional non-VA loan. The trade-off. Yes, you are paying the closing costs and getting a conventional rate on your first property, now a rental, but in exchange, you get your full, unlimited VA entitlement restored. The benefit, full entitlement, means you can purchase your second home, your new primary residence, for zero down, regardless of the price. This maneuver is almost always the financially superior move, as it frees up the cash you would have spent on a down payment to use for renovations, reserves, or investments. The strategic positioning. You are sacrificing a small amount of value, the low VA rate, on the rental, to gain a huge strategic advantage, the zero down power on the much more expensive forever home. It's a calculated move to secure a larger goal. Qualifying for the second loan, the rental income offset. This is the key to preventing your debt-to-income, DTI, ratio from sinking your second loan application. The debt anchor. Your mortgage payment on the first home, the new rental, is still a debt against your DTI. The tactical offset. Your specialist VA lender will allow you to use the rental income from the first home to offset that debt. The requirement, you need a fully executed lease agreement on the rental property. The lender will take 75% of the gross rent and use it to cancel out the mortgage payment debt. Example, if your first mortgage is $2,000 a month and the property rents for $2,400 a month, the lender counts $2,400 times 75% is $1,800 a month. This nearly erases the debt, keeping your DTI low and allowing you to qualify for a second, larger loan. This entire transition is about controlled movement. You have secured your first asset, proven your intent, and are now moving your financial leverage onto the next target with maximum firepower. No tactical operation is complete without a robust force protection plan. In the stepping stone strategy, this means protecting your transaction from any suggestion of fraud and maximizing the tax benefits of your new landlord status. Force protection. Audit-proofing your intent. The VA's core concern is that you bought the property with the premeditated intent to use it only as a rental. You must be able to prove, if ever asked, that circumstances changed after you closed. The paper trail is your armor. Maintain a meticulous record of the 12-month occupancy. Homestead filing. File for the Florida homestead exemption on the property. You cannot file for homestead on a pure rental. This is irrefutable proof of primary residence intent. Utility bills. Keep the first 12 months of utility bills in your name. Change of circumstance. If you move out early, ensure your reason is documented. PCS orders, job change letter, family relocation. Never move out without a documented reason. Process consistency. Consistency is key. Ensure your real estate agent, loan officer, and closing documents all reflect the same truth. This is your primary home. Do not discuss rental plans until the 12-month occupancy period is satisfied. The landlord tax shield, the depreciation advantage. This is the civilian wealth building power of the stepping stone strategy. Once the property is legally converted to a rental, it becomes a depreciable asset under the tax code. Depreciation is the silent anchor. Real estate depreciation allows you to deduct a portion of the property's value, excluding the land, against your rental income every year, even if the property is physically increasing in value. This deduction is a massive, non-cash expense that lowers your taxable income. The practical example. You buy a home for $400,000. Land is typically 20%, so building value is $320,000. The IRS allows you to depreciate the building value over 27 and a half years. So your annual depreciation deduction looks like this. $320,000 divided by 27.5 equals $11,636 per year. If your rental income after expenses is $100 a door, what we call a rental unit, that's $1,200 for the year, you can use the depreciation in deductions to offset other taxable income. This is the definition of passive income with an active tax shield. As always, this is not tax advice. Consult with a tax professional for your personal tax situation. With that being said, that property just gave you over $11,000 in tax credit. The risk mitigation play. A fundamental rule of investing is having adequate reserves. The 6-month reserve standard. When you convert to a rental, you must have an emergency fund equal to at least 6 months of your total mortgage payment, PITI, for that property. This fund covers vacancies, major repairs, stuff like AC unit failure, roof leak, or an eviction process does happen. Although we love renting to fellow service members due to the guaranteed rental income, things like deployment orders and government shutdowns do on occasion happen, so let's be smart here. The insurance shift. Contact your agent and convert your homeowner's insurance to a landlord insurance policy or dwelling fire policy. Your standard homeowner's policy does not cover you for tenant liability, rent loss, or damage to the tenant's possessions. This is non-negotiable force protection. Be sure to have your tenants carry renter's insurance. This is the difference of you paying for a hotel stay or your tenant's insurance company paying if a major repair has to take place. The stepping stone strategy is the most powerful path for a veteran to jumpstart their real estate portfolio. It minimizes your risk, think zero down, maximizes your leverage, and shields your income. This is how you build a financial legacy. To anchor the power of the stepping stone strategy, let's look at the strategic principles behind it, emphasizing why this single legal maneuver provides more financial firepower than any other first-time homebuyer strategy. Principle 1. Scaling with velocity. The goal is to acquire high-performing assets with as little of your own capital as possible and scale the portfolio quickly. Application. The stepping stone strategy is a direct application of this. By using a zero-down VA loan, you deploy zero capital into the down payment, which frees up that capital for the next acquisition or for reserves and renovations. Your capital velocity is maximized because the VA takes the primary risk. The quicker you establish the 1-year occupancy, the quicker you can redeploy your eligibility into the next primary residence. This is not about one transaction. It's about setting the cadence for a 20-year portfolio build. Principle 2, cash flow and operational efficiency. We must focus on maximizing cash flow and avoiding unnecessary frictional costs. Here's the application. The avoidance of refinancing is the single biggest operational win. Refinancing a $400,000 VA loan into a conventional rental loan costs the veteran thousands in closing costs and forces a higher interest rate, since investment property rates are always higher than primary residence rates. The stepping stone strategy legally allows you to keep the low VA rate, maximizing your monthly cash flow from the rental. This is a perpetual cost saving that translates directly into higher monthly returns, the most efficient way to run a real estate asset. Principle 3. Process for maximum value. The most predictable outcomes come from the best, most rigorous processes. This is the application, the strict 12-month occupancy window, and the requirement for meticulous documentation, homestead, utilities, lease. It is all a process-driven mandate. If you follow the process, the outcome, zero down second home purchase and rental conversion, is nearly guaranteed. This includes formally using the one-time entitlement restoration to ensure the VA's records are clean before seeking the second loan. A clean, predictable process minimizes the chance of delays or denials that burn cash and time. Principle 4. Strategic market positioning success comes from being unique and having a strategic advantage over the competition. Let's apply this. The stepping stone strategy is a unique advantage only available to the veteran community. Period. Full stop. No civilian first-time home buyer can buy a single-family home for zero down, convert it to a rental in 12 months without refinancing, and immediately qualify for a second, larger zero-down primary residence using a one-time restoration. This benefit makes the veteran the most potent first-time buyer in the marketplace, able to execute an asset acquisition strategy that others cannot touch. This is a decisive strategic advantage that must be deployed aggressively. This entire episode is a strategic playbook for using a military benefit to gain an unfair, ethical, and entirely legal advantage in the Florida real estate market. We have completed the mission brief on the stepping stone strategy. This is the blueprint for creating immediate generational wealth using the most powerful loan instrument available to you. Here's the after-action report, the final checklist before execution. Intent is non-negotiable. Certify your good faith intent to occupy the home as your primary residence. Plan for a 12-month residency period unless you have a documented PCS override. Maximize the force. Strongly consider a duplex or fourplex acquisition to generate immediate, powerful cash flow from day one, using the rental income to help qualify for a larger loan. The transition. After 12 months, move out, secure a lease, and decide on the one-time entitlement restoration to secure your next zero down purchase. Use the 75% rental offset to qualify for your new loan. The force protection. File your homestead exemption and convert your insurance to a landlord policy. Start tracking expenses and be ready to deploy the depreciation tax shield. The stepping stone strategy ensures your first VA loan is not a roadblock to future wealth, but the crucial foundation of your investment portfolio. It turns a temporary place of residence into a permanent income asset. Do not passively wait for the housing market to change. Use your entitlement to force the market to work for you. To ensure you execute this strategy flawlessly, I have compiled a stepping stone tactical checklist, a one-page guide detailing the 12-month timeline, the duplex rental income formula, and the exact steps for the one-time entitlement restoration. To download your free stepping stone tactical checklist right now, DM me the word JUMP on social media. Until then, go find that duplex. Remember, everything you want is on the other side of fear.